Okay, and since you guys asked for it, you wanted me to come up with a video for you that compares Fannie Mae and Freddie Mac multifamily financing. Well, what I want to start by telling you is that in 2004, I introduced these two mega loan programs to my mortgage banking company, Apartment Loan Store. And in those days, the minimum loan for both programs was only $300,000. Well, actually, $300,000 for Fannie Mae. Freddie Mac had not yet come out with a small loan program, so it was $1 million for Freddie Mac. But what really amazed me, I loved it because now the banks could not compete with me, where before it was the opposite way. Why? Because we could fix the rate for up to 30 years, and we could certainly, our average program, we fixed the rate for at least 10 years, and the banks were just doing 3- and 5-year fixed rate mortgages with a 25-year amortization at best, and we could do a 30-year amortization, and we could even offer interest only. I mean, it was just like a whole new ball game. But what really surprised me back then was how these two loan programs could have most things in common, yet their small number of differences could make or break a deal. Since then, we are always getting asked, what is the difference between Fannie Mae and Freddie Mac, and which is the best? Well, this is kind of like asking, what is the difference between United and American Airlines, and which is the best? What you really want to know here is which airlines is going to get you to where you want to go with the best terms, for the best price, with the least amount of discomfort. Now, when comparing Fannie and Freddie multifamily, what you really want to know is which loan program will get you to where you want to go with the best terms, for the lowest payments, and with the least amount of discomfort. And that's what this video is about. So in a moment, I will be going through the attributes of these two loan programs side by side so you can decide for yourself, will it be Fannie or will it be Freddie, or maybe neither will be a fit. I'm Terry Painter, the president of Apartment Loan Store, where since 1997 we have had over 40 multifamily loan programs to choose from. I'm also the author of this over 500-pound, well, I'd like to say pound because it's a heavy book, but it's actually 500-page book, The Encyclopedia of Commercial Real Estate Advice, which has everything from A to Z on the subject, plus great stories from the successes and failures of my clients. Sorry, but I've included the failures too. Okay, so let's get into Fannie Mae and Freddie Mac multifamily loans, which have so many more similarities than differences. I will be going through the similarities first, and you don't even have to take notes. You can just go to my website at the URL below to find a great chart that compares over 25 terms and guidelines for these loan programs, also qualifications. So what do Fannie Mae and Freddie Mac apartment building loans have in common? Well, both are called agency loans and both are GSEs, which stands for government-sponsored enterprises. So are Fannie Mae and Freddie Mac owned and run by the United States government? Well, most people certainly think so, but no, they're not. Both are actually publicly traded companies run by themselves that had bankruptcies during the Great Recession, and both were saved by the US government, which doesn't own them but oversees their finances in conservatorships. They are both doing really well today, but are expected to be watched closely by the Federal Reserve for another 10 to 15 years. Another misunderstanding is that Fannie and Freddie make loans. No, they don't. Both GSEs have approved lenders that do the heavy work for them on this. All Fannie and Freddie has to do is securitize their loans. Well, there's really quite a bit to that as well, but what they're really doing is guaranteeing the loans so they can then be bundled and sold as high credit-rated mortgage-backed security bonds on Wall Street. Okay, starting with loan size. Fannie and Freddie loans range from $1 million to, I guess if you need it, over $100 million or even more, with both having a small and a large loan program. Now, if you're building green, or if you happen to have 20% or more units with affordable rents, you will get 40 bips of a discount off the rates. That's 0.40% lower in rate. That's really good. Now, as far as amortization goes, both loan programs have a 30-year amortization. But what makes both of these programs so outstanding, and I love this the most about both of these programs, is that you could get from 2 to 10 years of interest-only payments based on LTV and DSCR. But keep in mind, Freddie kind of cheats on this one. Freddie factors in the size of the market or city in this equation. So in smaller markets with small population centers, they give fewer years of interest-only payments. That doesn't seem fair, but I guess it works out for them. Another plus is both loans are resumable and both are non-recourse, which is a huge plus for those of you who are getting loans only from banks. This means you don't have to personally guarantee the loan and risk losing your personal assets. It's also great that both loans will allow up to 35% of the square footage or up to 20% of the property's gross rents to be occupied by commercial tenants. So if you have a mixed-use property with commercial tenants on the first floor, this program is just right for you. So, just so you know, both Fannie and Freddie do not allow subordinate financings. Now what we're talking about here is a second mortgage. For that matter, banks hate that too, unless they do the second. And that's true for Fannie and Freddie as well. Both Fannie and Freddie have supplemental loan programs, and they're really great, which means that after the first year, you can get a second mortgage for up to 75% from Fannie or Freddie. Yes, the property's value has to go up maybe quite a bit, so let's think about waiting until 2 to 3 years before you apply for that second. Okay, let's go into prepayment penalties next, which are very similar with the choice of either yield maintenance or a declining prepayment like a 5, 4, 3, 2, 1. You can go to the URL below for an article I wrote explaining yield maintenance. It would take me far too long to go over it now, but in a nutshell, since these loans are sold to investors that are promised a rate of return for the same number of years that your rate is fixed for, it's going to cost you big time to prepay early if rates go in the wrong direction. If you think about it, it's only fair because let's say you invested in one of these mortgage-backed security bonds, and you're expecting to get a great rate of return for 10 years, and now somebody who is part of that decides, oh, I want to prepay my loan, and maybe after 2 years, and sorry, no more money for you. Well, it doesn't work that way. You can prepay, but it's probably going to cost you, on yield maintenance, it could cost you as little as 1% if rates go in the right direction, but if they go in the wrong directions, you don't want to go there. Okay, let's get into the borrower qualities. Both programs require that your net worth be equal to or larger than the loan amount, and that you have at least 12 months of loan payments in cash when the loan closes. So you can't be broke at closing. So don't even think about that. But I'm going to tell you a secret since I make these loans. You can actually get by with only 9 months. So it's just that 9 months will probably get the lender feeling pretty cozy knowing that you're not broke. So if you don't have the 12 months, you can get by with 9 months. Both loan programs average a 1% loan fee on the small loan program, and you will need to come up with about $10,000 as a loan deposit to start the loan, but more like $20,000 for the large loan program. The difference mostly is because of a large loan program, legal is really expensive. Okay, so some good news on both programs. For the borrower, tax returns are not required, but the underwriter will look at all your business and investment properties to make sure they cash flow positively. Both loan programs require 90% occupancy for 90 days, and they both collect tax and insurance impounds monthly. So that could be another a headache for some borrowers, but keep in mind you're going to be paying these anyway, so why not just know it's done for you. Okay, and also both of these programs have replacement reserves. Let me explain what replacement reserves are. This is kind of annoying for a lot of borrowers, but unless you plan on being a slumlord, which I'm sure you're not going to be, it's really not going to be that much of a headache. The lender is going to collect an average of $250 per year per unit to go into a rainy day fund that can be used to replace small things like a hot water heater or large items like resurfacing the parking lot or replacing the entire roof. This comes to $2,500 per year for a 10-unit property, so it's really not that much. But it will be collected with your mortgage payment every month. Okay, yes, the lender has this because they want to make sure you have the money put aside to keep the property in good condition, and this also ensures that the bonds representing these loans have high credit ratings. Okay, so now let's get into how Fannie and Freddie multifamily loans differ. Freddie has consistently had the lowest rates for the past 2 years, but not anymore. Fannie is catching up with the lowest rates, or I should say coming down. But what I love about Fannie Mae is that their rates are the same for very small markets as they are for large ones. And this is something that's really inconvenient about Freddie Mac loans, because they raise the rates for smaller markets. Like about a month ago, our firm closed a Fannie Mae loan in Baker City, Oregon that has a population of 9,700 at about the same rate as a loan that we closed in Los Angeles. They were both in the very low fours with a population of 4 million. So focus on this. This is where Fannie and Freddie really differ. Freddie raises the rate, the LTV, the debt service coverage ratio progressively based on the size of the market. So in LA, a Freddie loan will have an exceptionally low rate, go up to 80% LTV, with a 1.2 debt service coverage, that's really low, and an exceptionally high rate in Baker City, Oregon, with a maximum LTV of 60%, and they'll require in Baker City a 1.55 debt service coverage ratio, which is going to be hard to make. Well, you know what? I don't even think they will even do Baker City, but they really, I've seen them do maybe population centers as low as 15 to 18,000, but I don't think about 9,700 is going to do it for them. Okay, another big difference is how long you can fix the rate. Fannie wins big on this one, which is up to 30 years, where Freddie can only fix the rate for up to 10 years. I love that on Freddie's small loan program, up to $7.5 million, you can lock the rate at application, where Fannie cannot compare here. Their rates float, like most commercial loans do, until loan approval, which is about 45 to even 50 or 60 days after you start the loan process. Now, let's talk about borrower quality differences. Freddie Mac wins here with the lowest credit score of 660, where Fannie's is 680. They're still really pretty low, but I should make it clear that if you have credit scores in this range, do not think you can get away with late pays, tax liens, or BKs, certainly not a BK in the last 4 years. And if you do have these items, you're going to need to really have a good explanation for why you have them. Lastly, Fannie requires the borrower to have a minimum of 2 years of prior multifamily ownership experience. We're talking about on 5 units or more, not 2 to 4 units or something. Freddie is much more lenient on this, and we could do a lot of first-time commercial loan borrowers or multifamily loan borrowers with Freddie, because Freddie does not require prior borrower experience as long as you live within 100 miles of the property. So that way you can keep an eye on it, which really makes sense. Okay, so just as with the airline scenario I gave at the beginning of this video, you really need to know your objectives for this loan between Fannie Mae and Freddie Mac multifamily financing. And of course, you'll be thinking about which loan program gives you the most comfort and allows you to sleep the best at night. For example, if you're going to keep this property forever and are going to worry, I mean, if you're really a worrier, this is what you'd worry about rates going up in the future, right? Well, then you can choose a 30-year fixed, fully amortizing Fannie Mae loan, and it will be the last loan, I assure you, that you'll need to get for the property. But keep in mind, on both of these loan programs, the longer you fix the rate, the higher the rate. So, if you enjoyed this video as much as I enjoyed making it, please hit the subscribe and thumbs up button. And for current apartment building mortgage rates and more info on my loan programs, you can find a link to Apartment Loan Store below, as well as a link to my book, where you can download a great free first chapter. And that's about it. And thank you for watching, and be well. See you on the next video.